Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings, and thank you so much for joining us. It is Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm joined by Hans Albrecht, who is our options mentor in our member Slack workspace for LaDuc Trading clients. And we're very glad to come here every Wednesday afternoon, but especially this Wednesday because we have Nvidia earnings in a few moments, about 20 minutes after the hour, and lots to talk about as it relates to this recent pullback. And will Nvidia mark a bottom? In other words, will we get even some selling into tomorrow that actually then gets bought? That's kind of my baseline bet into the end of the week. Although this move lower has been quite quick and intense, mostly, I believe, from last week getting that trigger by the Japanese bank that had a bank run. Unrealized losses were crystallized, and basically, even though it's a smaller bank relative to the whole system, it did trigger a nice little yen spike with continuation yield, our US yield selling off. So that rate differential really did create a headwind for equities on top of some other economic data that came in with worrisome kind of economic triggers of slowing retail sales, etc. But for the most part, we have lots and lots to dig into as it relates to China plays and, of course, Nvidia and volatility. Last time we were here, Hans, we were talking about outsized March calls that were coming in, hundreds of thousands of contracts. You did some research on that as well, and they're kind of positioning for potential risk of, at the time we weren't really sure, but government shutdown risk on March 14th, Nvidia earnings right now, jobless claims every Thursday, but non-farm payrolls next week. So these were March expiry, and you were going to talk a little bit more about that.
Yeah, so we've seen some skew really pick up in options markets. So we saw the skew kind of relax into some of those, into sort of the period when we got above 6,000. And then suddenly people started to really start hedging quite aggressively again. We saw that big order that you pointed out, Samantha, which was an extremely large order last Friday, people coming in and buying a significant number of puts to the downside as protection, 95 puts. So that would be 5% out of the money puts. So not too far out of the money, but a little bit more urgent, a little bit more, I think, as a kind of short-term kind of hedge, just in case we drop, because we've seen quite a number of drops below 6,000, but we haven't seen much in terms of follow through. But overall, I'd say that the gamma profile is quite positive. We did see a lot of gamma bleed off.
We are in negative gamma. So
yeah, dealers
talking about VIX.
From the data, yeah, on the VIX side of things, there's a bit of risk to the upside. But having said that, I think we can probably say that the VIX has actually been very well behaved, considering what's happened in the last week to 10 days. Actually, in the community, I sort of said down 3% from all-time highs feels like down 10%. It feels like, I don't know what down 10% would feel like. It would probably feel like 2009 practically, because we've just had this sort of persistent shrugging off of data not data. I mean, the data's been relatively good, but shrugging off of worries as the market's just pushed higher to all-time highs. So I see a lot of panic out there and people getting run over on short put sales on a market that's really come off 3% from the highs. Now, that belies some of the underlying, yeah, well, that's the thing, that there's momentum, of course, has been slammed, right? So momentum is a different story. We've had, yeah. So we've had a lot of parabolas, and a lot of people who play the kind of weekly cash secured put game, trying to generate those kinds of cash flows week after week, tend to get drawn to those higher beta names, the parabola stocks, the things that are giving you that extra little bit of premium, as opposed to some of the boring old stocks, which I don't know if there's too much that's boring out there. We've seen even sort of calm defensive type names do very well over the last couple of years, over the last year rather, 6-7 months probably mostly. You can get hit pretty hard once things do turn around. So you get a parabola like Palantir goes to what was it, 125, 140? I can't even remember where it got to.
125.
125. And so it unraveled things like Hood, SoFi, some of those favorite names, they're almost meme-ish.
Tesla.
And they cat Tesla, of course, Tesla, 470 to 290. I mean, it looked terrible again today. So the whole Trump trade is really kind of unwound, except for, I'm almost wondering, is Bitcoin sort of that last domino to kind of fall in terms of those Trump bump trades that really went. So we started to see that actually unraveling a little bit over the last few days on the chart. And so I think some people are sort of staring at that gap to be closed as well. I think that gets us down to, at least on the IBIT, something like 42, 43, and then perhaps a little bit lower to pre-election. So maybe we need that to unravel.
200-day. Mostly the 200 day. So a lot of these high flyer or high beta stocks have definitely reverted to the to the 200 day or 100 day if they were like Meta and such, very extended. But let me just show you just an example of this contrast that you're talking about right now. So this is high beta relative to low beta. And this is a chart of very large spread. Now, I literally just posted about this last night for clients, which is also part and parcel for the puts that you're talking about that were crash puts really, really, really raced after on Friday. So this is from the Friday huge customer buying of crash puts. But in particular, that spread that we're just talking about, the high beta, it was in fact, let me just kind of show you if I can get it to place without my glasses on, without making you all crazy and dizzy. It's also related to this growth value rotation that's really kludgy looking chart, but with my bet that we were going to fall in this growth rotation down to this 2.05. But yes, it was the high beta. If I can find it, I'll show it to you in the meantime. Keep going. But yes, we were just talking about massive spread between high beta and low.
Well, and that huge trade on the Friday, that puts dealers offside on gamma. So that gets them short gamma. So that creates a little bit of tension there in market. So we're sort of back to 6,000, which is a little bit more calming. My data at least shows that dealers are generally long Vega up here, which is long gamma. They're basically in okay shape. If we get down, I'll show you guys some charts in a moment when we flip over. But for me, and I kind of said to you at some point this week, I said, you know what, Samantha, I'm generally a bull. I think that's why we kind of have a bit of fun too, because we sort of have a bit of a yin and yang. And I'm kind of, I don't want to go fully over to, and I'm not saying you're bearish because you did call that 61.25 and are up around that range. So you're very good at pivoting. But generally speaking, I'm kind of, yeah, no problem. Strong economy. Everything is going to be fine as long as the storyline is strong. I don't care about not fundamentals, rather. I don't care about metrics and valuations. Things like that aren't as important when the story is very strong. This could develop into something that I think is a little bit more durable, because really, I think the idea was that after the election, everybody really focused on those strong points. It was regulation, it was tax cuts. They didn't want to think about all this other stuff that was potentially on the horizon. And it's happening. It's finally happening. And then number two, this idea that Trump is so pro stock market that he's got our backs. He's there for us. There's this Trump put. It almost feels like he's kind of abandoning that for lower rates. He wants lower rates. And he's sort of going, well, maybe I don't care about how many things I'm going to break in the meantime. And that's very, very unsettling to markets right now. And we're starting to see a little bit of confidence erosion in the consumer. We're starting to see a little bit of business confidence erosion, a couple of surveys that came out, confidence surveys. So there is some signs that dreaded stagflation word might come back into the equation, which would be, of course, persistent inflation, perhaps pushed higher by tariffs and some of the things that are going on, and then slowing growth. So this is something that the market is not going to be, it's going to be more difficult to shrug off. So I'm finally maybe turning to the dark side a little bit, at least from a worry standpoint, and just saying, this is something that, and my job a lot of the time is to really measure the durability of volatility. Try to figure out, okay, is this just a quick blip that we can trade, or is this something that's going to be more with us for a little bit longer? And that's important to know, because that has you completely reevaluate what you're doing, right? You're going to sell the rips instead of buying the dips. You're going to have to flip your brain into a different kind of mode if indeed this becomes that kind of market. So I'm not 100% sold on that, but there's some damage on the charts right now, and definitely fundamentally, metric wise, I mean, there are some problems. There's some, definitely, I'm looking at some of these inflation numbers. Some of these numbers are concerning.
Things from that, because I literally just wrote about that yesterday and I found the quote. So over the past week, the S&P has lost 2.8%, but the high beta index lost 7.6%. The high flyers that we were talking about that did a reversion to the mean, which means in my world, because as anyone who knows, I look at the chase, the swing, and the trend time frame, the hour, the day, and the week, and I'm always measuring the week price action relative to the 10-week EMA close. And that is very, very important, because when it gets too extended, it tends to come back. I call it a reversion reversion to the mean trade. So that's another reason why I'm stalking my growth value rotation, interpret, that chart, because I know that when we start to get a pattern together, this is going to favor one or the other, growth or value. And it did not favor growth. Long story short, high beta lost 7.6%, while the low volatility index gained 2.2%. Now, the other things that I had I'm harping on, because I think it's important as it relates to the backdrop of the macro, because I am growing much more bearish. So this is me toward the end of the year. But again, I'm just going to read it. It's a lot easier. Right now, that consumer confidence report that came out was actually a really big deal. So this was not something that was light as it related to a readout when we had the 10-year drop below 4.35. It actually was my level that I was waiting for this on this bond long, right, yen long trade that's been going on since January 14th. So I really had 4.35 as my price target on the 10-year yield, and it dumped below it on that consumer confidence report. That was actually, it plunged. It didn't just fall. The consumer confidence plunged to 98.3 from 105.3. And then you kind of look at the inflation print of what consumers are expecting. They're expecting 6%. So that is 3 times the Fed target. It is also the biggest dump in 3 years. So we've got a situation where job announcements on tariff hits are starting to hit, right? Like Alcoa is saying, we're going to have to lay off 100,000 people. I mean, this is like, people are not really able to model in the impact yet, but the consumer is already nervous. They're already looking ahead going, we don't think there are going to be so many jobs in 6 months. And that's exactly what these surveys are measuring. So CFOs will also start to take note. Less hiring. Of course, DOGE is still in full effect, hitting the government sector with not just budget cuts, but also labor shedding. That labor shedding is not just government jobs. For every 1 employee in the government, there are 3 contractors and related funds that feed into that government.
Right.
This is
good point.
Yeah. So
it's a snowball effect, isn't it? It's a snowball effect. Yeah.
It hasn't started, but when it does start, it typically does not slow. It typically picks up speed. So we're not there. And the irony of this is, even though I'm looking at jobless claims coming in, next Thursday and the following, and picking up some speed, which is, of course, another reason why I think non-farm payrolls could be eventful. It's actually the opposite. Non-farm payrolls, when they come out and we see a lower unemployment rate, people are going to be scratching their heads. But the reality is we could have a situation very much where, because of immigration slowdown, for lack of another word, right? Policy intervention has pushed now that flow of labor coming in, national security, all of that. But that means less workers to fill the jobs. So the fact that we have actually a falling labor pool, even if the number of jobs declines, which it is, the labor pool is falling, the unemployment rate could actually still fall, but it doesn't mean that growth is going to expand. In fact, the opposite is very likely. So we're actually going to have more likely an economic slowdown to the end of the year, even if unemployment doesn't trigger higher. So kind of
how much do you think, Samantha? Yeah, that's kind of a funny thing, right? It's almost like the numerator denominator, right? Sometimes, when I look at skew, I'm like, well, what is skew doing? Well, it might be the calls, might be the puts. You have to kind of figure out what's going on under the surface, under the hood there, to get the whole story. What do you think, though, about this idea that ahead of the tariffs, you're going to see a bit of a sort of an artificial bump? People start to pull forward some of those inventories, start to go, my gosh, things are going to start going up. So that maybe gives us almost an illusion that things, at least from a little short-term perspective, that things are okay. Is that fair?
It's already been happening. So, Trump expected to win, and then Trump winning, it has pulled forward a lot of demand, actually, and orders. Over time, what happens is not only do tariffs bump up prices of the imports, but it also creates this shrinking of goods and services that we can consume. Again, that, denominator is in play. But we have got to figure out, I think, first and foremost, what happens with the debt ceiling. And this is actually a bigger issue in the short term. So it's very likely Trump's not afraid of doing a government showdown, and not at all. He's really not afraid of this. So I would not surprise me one bit if we get a shutdown on March 14th. And I've got some reasons behind that I've written up for clients. But the point is, we don't have a lot of risk right now. Nvidia is going to come out, in a few minutes. But I mean, as it relates to earnings, there's still expected 20% earnings growth between Q2 and end of year. Very unlikely in my humble opinion, but those fundamentals have not been re-rated yet. So the market is still holding sideways in this tight range since the election. So we're going on 3.5 months. Lots of churn underneath. There's still stuff to buy. We rotated from the high beta into XLP, XLV, and TLT. That worked great. At some point, in lieu of rotation, there will be volatility. And that's why we're coming together to kind of look at those massive VIX calls that came in to revisit, is that now a situation where everybody's focused on those VIX calls and now we won't have volatility? Is there some type of, I personally think we're still going to get volatility. I mean, just from my analysis, but is there a system for you market makers that actually says once everybody's paying attention to it, it won't happen?
I don't think so. I think it's a bit like gamma, that we require a spark to get us to the point where the accelerant can kind of kick in there, right? It's almost like the kindling is there, so that I think one day, and the VIX has been quite well behaved. I don't think we've maybe touched 20 this week, but didn't get too far past that. And really the curve, I mean, we see the futures underneath the cash. So there's definitely a little bit of worry out there, but in terms of the shape of the VIX futures curve, not really massively worried by any extent. So I think what you're referring to is just kind of this dealers being very, very offside. It's quite clear from some of the data.
By the way, so they did report and they beat on the top and the bottom. We still have to hear about Blackwell, supply, and more importantly, if they're sold out for the rest of the year. But as it relates to EPS, 89 cents, estimate was 84 cents. So they crushed it. Revenue, 39.3 billion, estimate 38. So they did fine. So they were expected to beat analyst expectations, by the way. That's so far check. Now with a conference call, we need to find out more about that whole supply demand dynamic, so that the market can react and price their future growth. Didn't mean to interrupt, but I wanted to be hot off the presses.
No, that's great. That's great.
Well,
I'm glad. Yeah, we'll see if Jensen. I mean, I don't know if he's going to throw anyone under the bus here, but I think from most of the data that we've been hearing, everything looks pretty good out there from a CapEx spend. I mean, there's really been almost no sign. I mean, there was that report about Microsoft earlier this week that apparently was, sort of debunked fairly quickly, at least some leasing data. But outside of that, there really hasn't been too much to kind of dissuade people from thinking that there's continuing to be this big CapEx spend, certainly from the people who really spend most of the money in those big cap tech stocks. They seem to be full speed ahead. Interesting in Nvidia, what is typical in Nvidia, Spot Gamma pointed this out. They said, typically you sort of see very exuberant call buying into these events. And we've seen that for a couple of years now, until perhaps more recently. And this time we saw actually downside puts being purchased quite aggressively versus upside calls. So those upside calls were actually a little bit on the cheap side on a relative basis, right? Not super cheap, but I think they were expecting about an 8.5% move. And
real quick, yes, keep talking. And hopefully comment about the screen. I'm not quite sure. Is it being displayed in full? I hope so. I've got aftermarket over here, and your 8.5% expected move for Nvidia. It just so happens to coincide with a gap fill about 119 and a target of about 140. So last quarter we did this, and I literally said this is a premium seller's dream, right before Nvidia, and it did this tight thing. And I said it kind of looks like the same thing, but it wouldn't surprise me if we do come down tomorrow, get some selling, get this defended. In other words, even if we were to come back down at 119, I still think we would get defended. Continue. I just wanted to kind of show that. That's
but
the
it
range.
looks like initial reactions are there's nothing of super concern in there. But that's funny. We're on the same page there. I put out a video this morning saying I think that's a little bit on the high side. 8.5 to 10% is a little bit high for Nvidia for this report, I think. And sure enough, it looks like we're kind of unchanged. That can obviously change a little bit as we get into the event a little more deeply and the call. But people have been a little bit nervous, and I think this is going to put to rest some of the worries about AI. We'll have to see what the language looks like, but it's going to be interesting. But in terms of the overall picture, let me throw in.
Yes, and also it was funny this morning. I actually tweeted and shared with clients in my live trading room 2 tweets that one was bullish and one was bearish on Nvidia. The first one was Monster, which many know is a long-standing proponent of this, not only the semi space, but in particular Nvidia, and had some final thoughts about this being bullish, again, with focus on Blackwell demand and gross margin. So those are the two major factors that the market will be reacting to. So the fact that they beat was expected, but now how about that gross margin, and what about Blackwell demand? We might need to wait for the conference call. Anyway, the point is JP Morgan came out and said a blowout print by Nvidia would likely be enough to push us back to all-time highs as soon as Friday. So let's see, Nvidia makes up what, 7%?
I don't know.
I know, I said the same thing. I'm like, wait a minute.
I don't know about that.
We just dumped 6% in Qs. Nvidia makes up maybe 8% of Qs. I'm doing this from memory. I don't know how much from SPY. Honestly, I don't remember the weighting. I did at one point. But anyway, that's a lot. So the second thing that I tweeted this morning was the bearish look, which is by the Dean of Valuation, Aswath Damodaran. I'm going to say his name wrong, but everybody knows the NYU professor who basically had 90 as a valuation, fair valuation for Nvidia. And after DeepSeek, he reduced it $10. So he only sees the valuation based on this AI becoming commoditized. Doesn't matter about valuations. We know that. But someday it will. Someday it will. In the meantime, let's see what they say about demand and margins, because right now it's not really going anywhere fast.
Yeah, and you know what? Who was it? Elon came out this week and he said his XAI or whatever he calls it, they just built something 200,000 GPUs. I mean, these numbers kind of boggle my mind. That is not that area of expertise, that's for sure. But I always wonder, how many of these bloody GPUs do you need to build a fancy chatbot? So obviously I've got that completely wrong, but it looks to me like the AI spend is full speed ahead, at least for now. Here's that thing that somebody in the chat said, let's see some data. So here's your put skew kind of jamming up into the event. That downside skew, quite cheap, very unusual for Nvidia. So there's a little bit of an opportunity, and I think if we get the sense that it's settled here, I suspect that upside is actually going to remain kind of cheap, and that's going to be sort of the interesting play for me. This potential for it to come back. I still like power gen a lot as well. I know that you were talking about this week in the members chat, in your morning chat, that the uranium trade has come right off. I still like the power gen theme. I like Vistra. I like things like that, just because for me, no matter where margins go on GPUs, there's still going to be a need from, I mean, there will be efficiencies. They're going to find efficiencies, maybe to use a little bit less power. But for me, that still seems interesting, especially if it's cheaper AI for everybody. That just makes, the demands on power all that much more important. So I think that's kind of an interesting place. So, I've got some positions in VST, but here's that VIX dealer gamma imbalance that you were referring to, Samantha. So these dealers are quite short that upside. And this is actually kind of an interesting chart right here. So we see short Vega, not good acceleration. So remember, with gamma, it doesn't cause a problem, but if you get an event that pushes the market into an area of a hornet's nest of short gamma, then that's the problem, right? That's where it kicks in and starts to cause problems. But unto its own, it just kind of sits there and waits. But if we push VIX through 20 here, which it's having a lot of trouble getting through there, if we get through 20 to 30, 40, we do get a situation where dealers are getting more and more short Vega, which is basically, that's going to cause a problem and start to accelerate. They'll have to buy futures, they'll have to sell stocks, they'll have to do all kinds of things to make up for that. That's sort of the reality of our new market that we always talk about, the tail and the dog, and derivatives being such a huge part of everything. So here, as I can't remember who put this together, but we held the low 5900s. And really the idea from the data is that until you get to about 5800, that's where everything can kind of break loose and we may have a bigger problem, right? So it's sort of weird to think about that. If we're down to 5,800 or 5,700, that's when selling can really start, right? That's almost like, well, the market's already off 400 points. Now you're telling me there's a problem? Well, that's just the way that things work these days, as it pertains to the influence of these very, very large positions in option markets and other derivatives that we can't even see, in over-the-counter markets, things like that. So, but if we can recapture 6,000, you're kind of back into an interesting place from a stability standpoint. So when we talk positive gamma, negative gamma. Just remember, green positive is stability and red negative is instability. And so again, I sort of mentioned last week in a couple of places, I said, we're going to have I think we lost like 60% of the positive gamma last week coming into this week. So as a result,
Friday.
Yeah, that's after OpEx. That's sort of the, room to roam about the cabin kind of situation again. So stocks were able to move around. And again, we're going to lose quite a bit this week, 70% roll off into that after that Feb 28th expiry. So yeah, so this is up to date. So we're going to have a little bit of positive. This is the JPM collar up here, which starts to get a little bit more important as we approach the end of March, because that's where it's positioned.
The top again, is it 62.55?
60
memory.
61.65, isn't it? 61.65?
Okay, I don't remember. Okay.
I think so. But it really doesn't, if we're down in the 59.50 range, it's going to have less and less impact, right? So it doesn't really do anything until you get closer to it. I don't think there's any kind of Vanna effect at this point or charm effect. I'm not sure if you're still short. I don't know what the delta is on these, but in my view, I would, if I was a market maker, and I wouldn't be short futures or stock against those calls at this point, I don't think, with a month left or very little. So we're going to be in sort of an area of markets continuing to move around potentially, and that's a little bit worrisome. So here's your skew kicking up again, markets getting a little bit nervous, and that's where we are. We're sort of in a well, what if this happens, and having to deal with this sort of 180 in terms of what people kind of thought. This is kind of cool here from Bloomberg, showing you all the Trump trade reversals, right? So here we are pushing up into that exuberance, and then discretionary versus staples starting to give back. There's your yield that you were talking about a moment ago. Here's your dollar. Here's your Bitcoin kind of hanging in there a little bit. So we wonder how low this could get. Maybe we could get into that $70,000 range, which I don't know what that does to things like MSTR. I mean, they're already looking so ugly. MSTR has been cut in half just about, and Bitcoin's only off about 15% from its highs. So these Bitcoin proxies have definitely shown their beta, but in the wrong direction of late. And then here we go, this sort of implicit growth expectation. And now people going, wait a minute, that's not what I voted for. I wanted good times. You're telling me we're not going to have good times? That's why I voted the way I did. So I mean, this is neither here nor there, but I kind of like the overall longer term view of this. I don't mind a little bit of a shakeup and fiscal responsibility and all that stuff, but there may be a little bit of pain ahead, right?
Have you seen the House budget got passed? There's no fiscal responsibility.
No,
this is embarrassing. I cannot believe bonds did not dump on this news. So, but
they don't believe it. Do they not believe it? Yeah, they don't believe it, I guess.
Okay. So anyway, didn't mean to interrupt.
But this is the reality of it, right? I kind of said this the other day. I said, we've sort of this phrase of kicking the can down the road. Imagine how long we've been saying that, Samantha. I mean, I can remember just saying that for like the last 15 years, going, oh, we're going to kick the can down the road again. Oh, we can print more money. We can do this. We can do whatever we want to support markets. Are we at a point where the can is hitting a wall now? I wonder, maybe. And that's a problem for markets, especially at all-time profit margins. That is a problem.
So I've got some strong opinions about that, because that really dovetails into what Jeffrey came on board to basically talk about and teach clients about, which was fiscal dominance. And that's exactly what happens. It eventually kills the bond market. Now, Trump and company, I mean, Musk has said, I wouldn't short bonds, and Besant is basically saying the same thing. And, Trump wants his cake and eat it too, equities and bonds. But long story short, they did choose to quote unquote save the bond market, and all this Doge busyness is not really producing the results enough or quickly enough. And then they're doing these House reconciliation bills, which are like mind-blowingly expensive. We're talking mind-blowingly expensive, $4 trillion over the next decade. That's not reduction, that's expansion. So that's not what people signed up for. It's the opposite, right? And it's scary. So yeah, in fact, that's the opposite direction we want to go, which would in fact crater not just bond market, but you crater the US Treasury market, then you kill the monetary system and our hegemony. But that is already what we're not talking about from an option standpoint, on a micro standpoint. But when this Doge started kicking in, you could see that bonds were getting bid. And then you could, we had other reasons. I had a very strong feeling last week that we were going to roll over because of my rate differential. It was very much focused on the dollar yen. So I was focused on an FX volatility that would seep into equity volatility because of sovereign bond exposure by this one Japanese bank that was having a bank run. This was before the executive order, Trump targeting China investments in all shapes and form that really the market hasn't acknowledged yet. And all we're focused on is Nvidia at 130. It just seems like we're missing the forest through the trees. But the bigger issue is right now, if this is going to be a farce, and some people believe it in advance, but I'm still waiting for the evidence, the weight of the evidence. If this fiscal restructuring is a farce, we're in trouble. If it's not a farce,
Right.
if it's not a farce, if they are serious about cutting spending, restructuring, then we actually do have a chance to get a little bit out of this. I still think we're going to have a slowdown from unemployment and economic contraction but it won't be as bad. But if they're just gaslighting us in the same way the Dems did, sorry, I am an equal opportunity. I am voter independent. So I can criticize both sides and I have no problem with that. But the point is, if this is a farce, we're going to start to see it in the bond market and yields would rise. Right now, that's not what we're in. We're actually in a deflation impulse where oil is falling and yields are falling. And I obviously said equities will fall. And then gold is starting to roll over. It's also extended. And one of the reasons why I think this whole package is happening, this kind of like macro trend trade that I positioned last week to clients, is because there is peace talk. So a forced armistice between Russia and Ukraine is peace. So it means that some of this, risk premiums coming out of commodities, et cetera, but also falling prices. So yields, oil, gold, all of that stuff makes sense with equities to come on down after a war is settled. Now, we don't have a settled war situation, but my point is it's leaning in that direction. The bond market, I think, is reacting to that more so than what Doge is doing. Does that make sense?
Yeah. It seems that way. You're right. But it feels like nobody really can get a handle on really what's going on. I mean, we've had these, the bond market thought we were going 5+%. Now we're heading back towards 4 again. So there's really just this kind of cross current. Here's your gold, Samantha. So we talked about this last week. I said, this is kind of a little bit exhausted looking. We were wondering about this upside call skew in gold getting pressed down. That's when, people are selling out their upside. They're selling out their calls, pushing that down. So this is a very unusual picture for gold, which of course for me is a sign that's a little bit exhausted. You could see the puts are more expensive than the calls. That doesn't happen very much on gold. Typically, it's kind of expensive calls, and that's kind of I've called it sort of the cover call dream kind of asset because you get that nice juicy upside call premium. Not enough in my opinion, but from a puts versus call perspective, you do get some benefit there. So yeah, I agree. I mean, gold's kind of looking a little bit extended here. Another one I mentioned today, this MSTR, which I like to look at because for me, it's like,
you love this one. It has ginormous IV, and you play this one, and I'm like,
you know what? Yeah, part of the reason I love it, Samantha, is because it gives you like a year's worth of volatility lessons in like a month. It's like you get all kinds of crazy stuff happening there. And so right now, you're kind of getting this was my sign early on. I grabbed a really great trade early on. It was this touch of this zero line where calls and puts put IVs are the same basically. We've gotten past there again today. So this is very interesting where the puts, they're starting to pile into the puts a little bit. Today I sort of said, well, that's kind of maybe a sign of a bottom. I feel like Bitcoin still maybe has a little downside, but something like MSTR may have kind of led Bitcoin and maybe it doesn't have as much downside. And I'm not saying it's not going to be a bit choppy, but this is sometimes a sign that they've exhausted the move to the downside. So it's not advice because this is a crazy stock, but it is something where I'm looking at. I covered a long straddle that I have. So I wanted to show people this sort of Vega bailout strategy that I did here. So I got into MSTR thinking the volatility was really, really low. And I was right. We got down to sort of the mid 70s, very, very low for MSTR, very, very low considering it got up to kind of the 200s. So I was thinking there's going to be a move, but I leaned long because I thought, okay, we're going to get going to the upside because they've really hammered this thing so badly. It was trading around 340. And I said, well, okay, I'm going to play this to the upside, but I know that so I put it on here. We're trading around 310. Sorry, it was dropping down to 310. And I put this trade on and I said, you know what, I'm going to lean long deltas because I feel like we could have a run back to 400 if Bitcoin stabilizes. But if I'm wrong, the volatility level is so low, the bump up in the increase in implied volatility is going to bail me out on my delta. So what I figured was, if I'm wrong, I'm actually maybe not going to lose any money if this thing drops $60, 50 or $60, because while I'm long delta, I'm going to get hurt on this Greek because that's my directional bias. I'm long. I want this thing to go up from a directional standpoint to give me an immediate sort of benefit. And I thought the vol wasn't going to drop on the way up. In fact, I thought it would go up as well. But I had this long Vega, right? So Vega is your exposure to implied volatility. So I'm long delta, I'm long a bunch of Vega, I'm short a whole bunch of theta. So this thing is costing me every day. It's costing me like $400. So I'm long a bunch of Vega though, and I figured if it drops, we're going to get that vol pop. And sure enough, we did. So we went from a 78 implied volatility to an 86 on a $50 or $60 move down in the stock, which bailed me out. So let me show you the math here just quickly. I don't want to bore people with math, but the idea is that I've lost money on delta. I've made, so on the move, plus it took a little while to happen. So I got hit on theta as well a little bit, but a bump up in Vega can overcome, some losses in theta, of course. So I probably should have lost about, I should have lost about $3,400, but I ended up losing like $300. So based on delta, I should have lost about $3,400, $3,500. But because the implied volatility went up 6 or 7 vol points, I benefited by $800 per vol point. Now I lost a little bit on theta, so I actually could have made money. If that happened immediately, I would have actually made money on that move. But because theta cost me a little bit of money, the Vega bailed me out. So it's always fun to put on a position where you think option prices are so low that you can have conviction, and that if you're completely wrong, you end up actually breaking even. That's really sort of putting the Greeks, lining those Greeks up to potentially benefit you. Now, there was no guarantee on this position. If it just sat around, it would have cost me theta. I didn't think the vol was going to drop anymore, so it wasn't going to really cost me much in Vega, I didn't think. I mean, it could have dropped a little, but I figured this thing was due for a move. We're coming into some big events, Nvidia, all the Trump stuff going on out there. How the heck is this thing just going to sit around? And so that's where you can kind of have a little bit of fun with long options. Typically, we're playing the short income options game, but it's always fun to have a little bit of long option activity in your book as well, to maybe to have a bit of ballast there, especially when markets start to move around. Right, you kind of have that piece that you can kind of play with a little bit because things are swinging around. So it's always good to have, like with a put vertical, I like having that long put that I can kind of play with as these stocks move around.
A good way to play gold, by the way, GLD specifically, with a put spread, expensive put, so to speak, even though it's at all-time highs. Which cracks me up. But as you mentioned with the expensive puts. All right, so we've got a few comments in here. What is this? 68,000, 825, and 50,000 are measured targets. And we're talking about Bitcoin. Let me just share a chart that I have, and then we'll talk about some comments and then other mentions here about China stocks given the executive order. Man, oh man. All right, first, hold on.
Should we look into shorting China stocks? I don't know. Baba is so cheap. It's still cheap.
Yeah, but wait a minute. We got an executive order that's a little bit different. So let's talk about this. First, Bitcoin. So I show this to clients every single day. Once we got out of this wedge down here, this kind of 67,500 area, the usual and customary technical analysis call, which I made down here, as it was doing this kind of inverse head and shoulder, getting up here, retest, great. This should double, right? So 65, 130. Now, problem is we got up here and we kind of went sideways in time, not price, until this recent rollover in the markets with high beta, which we've already identified is growth falling. And luckily, we did have rotation into low volatility, or we would have had high volatility. But in any case, this dumped, and this is the 200-day I was talking about. So this green line is basically where it needs to settle. Otherwise, it's going to come right on back down into 75. And that's all there's to say about that. But that's not what you were talking about as far as China.
What's that? That's the 200-day, Samantha? The 200-day is the green line?
200-day. So that was basically, if we're going to fall out of favor, and up here, this thick red crayon line is basically the 50-day. You know what happens. We Rejected here, we go down here. There's nothing to defend. Now, Bitcoin is not really my wheelhouse of interest. I'm much more interested in sector rotation, which is China. So I'm kind of showing that the other day I did a big piece for clients, which is Friday night when everybody was, I don't know, watching movies or date night or I'm online doing my market thoughts. And this is basically what hit in the wires, that Trump signed an executive order, which is actually a big deal. Now, the market didn't react, except we did gap down on Monday morning sideways, and then we gapped up again today because China's still buying. And by the way, even though US is going to be, investors are going to be disincentivized, it's much more targeted to China investment in the US. So I did say, hey, protect China longs. I think that matters. If you're highly leveraged, like for example, Jeffrey is 100% year to date in his portfolio trading China names. Jeffrey's our macro advisor. He classical economist. He's very, 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 very focused in value. Now that he doesn't know, he hasn't even looked at this yet. I actually pointed this out to him yesterday and said, well, what do you think about this? So he said, okay, they were still extremely oversold in China plays. He's up 100%. He has gone to IBKR to buy Hong Kong exchange stocks, not the Chinese ADRs that the rest of us are playing, like the Babas and the option market. So he's in a very different kind of, he's going with the market overnight in Asia, not necessarily what we're waiting for is the next morning to see what happens. Okay, so he's gone direct via IBKR, and we can do that as well, but just kind of keep that in mind. This is actually a big deal, this executive order, and money will start to go home. There's no question that that's kind of Trump's national security directive, is to get the China influence out of not just farmland and US companies, but also stock market, and it will have a hit on US treasuries, not all at once. That'd be very, globally recessionary. But the point is, it is a thing. It's a thing. So I think what it matters about this whole introduction is that, or lots and lots of words spent, is that we have a situation where US investors and hedge funds who are excited about the overvalued nature of China sector rotation versus undervalued versus the overvalued US high beta stocks, the Mag 7 and the like, are now going to have to think about this because we didn't have the same type of risk before Friday night. And I'm not one, and believe me, I studied this whole thing for 3 years after we came off the 2021 peak, all that delisting nonsense and the uninvestable China nonsense. This has been a solid theme for a year. So we got clients that have made buku bucks. I've been very focused on this, et cetera, until Friday night. So it's good to be risk aware. So my concept is China's still going to likely have its parabola. Anybody who's seen my China, monthly chart, they're in play. That's it. It's in play. China via Hong Kong. You can go to IBKR, go do your thing there. But as it relates to U.S. issues, there will be some disincentives for funds to hold long and strong. I think that's going to be kind of the gist of it. Right now, they're ignoring Trump. Right now, they don't care because they're making money, hand over fist. The options market isn't pricing it in, et cetera, et cetera. But I think at some point, this will come home to roost. And I don't mean delisting because, by the way, China did this immediately back in 2022. They went through the process of bringing these Chinese issues back into the Hong Kong market. So that's where they're being traded. We get the derivatives. We get the NAV difference, right? Like the MSTR and Bitcoin. We're trading these ADRs that are actually trading in Hong Kong. So they already did what they needed to protect their investment. We need to do the same. So I think it needs to be taken seriously, but obviously it's early and nobody's reacting to it right now. So it is what it is.
That's really interesting. Wow. Somebody's asking, is KWeb also exposed to this risk? Well, yeah, I imagine it would be.
Yes, and because what's happening is that the KWeb is mostly China Tech and FXI, and by the way, EEM, those are all ETFs and highly recommended, by the way, by LaDucTrading, myself specifically. But I know they should be less busy, but that's what I'm looking at is every release that comes a Friday night, I'm looking for Trump headlines. Anyway, this is the risk, but we knew this. Focus is going to be very much on Chinese investors, whether they're individuals, companies, or the CCP, I don't care. Their investment in the US ecosystem, from land to buildings to businesses to equities and treasuries. We're talking about the whole kit and caboodle. So I've written about that. Now, the knock-on effect, of course, is Trump is pushing US not to invest in China. China just said, hey, we want to, you're welcome to come in now to our manufacturing world. You're welcome to partner with us. And Trump is saying, no, no, no. And that includes investments. But no order has been given to stop Americans from investing. Obviously, this is an order. There's lots of execution and implementation and stuff. All this is early. It literally just hit Friday night. So the biggest one is going to be tax treatment against China investment, not necessarily U.S. investment in China. We're going to have a lot more to talk about in this regard. But I would just say be risk aware. It's actually, I mean, we're talking Trump is trying to negotiate removal of China from the most favored nation trading status. Not to mention the World Trade Organization. He's going after the jugular as it relates to creating revenue from restrictions on China investments, forcing China money and people to go home. I mean, this is a big deal, but nobody's looking at that. They just want to know about Nvidia guidance.
Right. But remember, the market's male, Samantha. It focuses on one thing at a time. But that's your job, right? Your job as an astute woman is to think of the other 17 things. And on Friday night, somebody said Trump is your date night on Friday night. So there you go.
Okay, so let's get back to options and what are you trading? Let's talk about something we can actually waiting for guidance. Unfortunately, Nvidia is not going to come out with a conference call until 5. I don't think he wants to cover that. They did miss a little bit on margin, so I was able to grab that while you were doing.
Let's see. Where's the trading? Yeah, it's almost unchanged right now. So much ado about nothing at the moment.
So 71% gross profit margin guidance, they missed. It was 72% estimates. That's not enough to worry about. So it's really going to come down to the language around Blackwell, because so far they have already kind of delivered. And of course, folks will take this apart. In fact, I saw a great tweet, because that's what I'm doing. I'm scanning while you're talking, and I can because I'm a woman, and basically said a lot of that also comes down to, guess what they did? They used a lot of money to put back into stock buybacks, and that's the financialization. But ultimately, you have a market that doesn't care. Until they care, until that story stock stops delivering on that good story.
Yeah, I mean, we've got there's the corporate buyback window that's still open. So we've got some tailwinds from that perspective. I'm still looking, what am I playing? I'm looking at power gen. Cameco's kind of disappointed me, so I'm sort of watching that a little bit more carefully. But some of the other ones are still doing well. I think that's kind of still interesting. And I'm sort of looking, I've been kind of talking a little bit about this idea that there almost could be, I might be talking crazy, but all this AI and particularly quantum may be quite disruptive in ways that the market can't really anticipate. I think maybe at some point that becomes like a little bit of an underlying story that, well, I know somebody who's very, very smart, very high CEO, tech CEO, and he says, there's certain companies that are basically screwed. He was talking about Salesforce. He said AI is basically going to eat their lunch. There's not going to be anything left. So he said there's going to be a day there where there will be companies that you thought had very wide moats and that had long runways for the next few decades that are suddenly going to be disrupted in big ways. So I almost wonder, and that can happen in this digital world, right? I mean, it's all zeros and ones. It's all just freaking.
I posted a non-AI name that I'm expecting the very same thing in a trend in our trend channel for clients that I expect in the next 2 years. But again, it is a tech, and it's not usually my focus for plays. A lot of people are. I like breakout stocks, but nonetheless, we're going to get through Nvidia at 5 o'clock and see what the market does tomorrow. You've got some plays that you're still, I know, invested in, and then you trade around, right? Like the Hood and the Uber and the such. Yeah. I'm very much timing the market, right? So last Wednesday, I posted all of the divergences that I had shown for clients that were very much focused on my volatility spread, my rate spread differential with the yen, and how I was expecting oil to dump, yields to dump, equities to dump, and gold to dump. And yesterday was actually the first day that gold softened, but the rest worked. Yen to move higher, et cetera, et cetera. And so we had a really nice pullback that we were very very well positioned for. And I then said yesterday and today, I expect that Nvidia and jobless claims will put a temporary bottom for a move. In other words, it'll stop kind of going down Thursday, Friday, and we'll probably have a little bounce. But big picture, no, I think we still have a lot of risk between now and options expiration, which is March 21st, specifically the government shutdown proposed potential, however you want to put it, March 14th, which normally is never even worth talking about, but this time it is. So we had one in 2018 under Trump. It lasted a good while. Markets fell 20% as a result until Mnuchin. Remember, he called the banks on Christmas Eve, and everything else after that was up and rosy. So I am expecting volatility, and I wonder if they have come in, the big hedges, big hedges have come in because of that, much more so than Nvidia. Also, because I run this live trading room, I'm looking at very large protection that keeps coming in every day at the money. Like, for example, if you look at even the FXI and the KWeb, very, very large at the money puts are coming in. If it's 140, it's a 140 put, 5-6 million. So Berkshire Hathaway also has the same kind of thing. Big puts are coming in at the price.
What kind of expiries? What kind of expiries, Samantha? What kind of duration?
April to June.
Yeah.
And lots of call selling, which is kind of typical and has gone for the par for the course, but it's a different character than we've had in the past. So they're buying at the money, lots of near duration, also expecting something near duration.
Exactly. That's what's happening out there. Exactly. I think people are starting to go, okay, now we need to, and of course the market at some point will look and see light at the end of the tunnel, right? But in the meantime, if we are in this sort of difficult period where markets have a lot to grapple with, I can see why that's happening. People are saying, listen, get me protection until the second half of the year where maybe we start to see, I don't know, that sounds a little bit early, but if we start to get you're certainly not going to get rate hikes anymore. I don't think. You may differ, but at some point, maybe we do get some of these.
Yeah, Fed isn't even going to be able, they've, increased some cuts, of course, but probabilities of cut, but especially as unemployment rate potentially falls, despite the economy slowing down, it puts the Fed on the sidelines, especially with sticky prices, especially with expectations moving higher. But because I am bearish oil and yields to a certain level, and my clients know what that is, we're still in the throes of a deflation impulse. And believe it or not, until we finish this phase, which is much more focused on, I think, commodities and this kind of whole war premium, we're going to have to kind of play out the debt ceiling near term. My goodness, also the whatever, Ukraine, I love to say it's a forced armistice because it's not really peace, whatever. We're going to have to get through those two, I think, pretty big events before Trump can get to push tax cuts and we can really see what Doge can do. That's all impactful. And in the meantime, we do have the risk of escalation with China, or I should say retaliation from China based on Trump's executive order, not to mention what might be in the bush with some bank troubles in Japan, which were absolutely outsized, not just unrealized losses in treasuries, JGBs and US, but crystallized. It's a different flavor. So the market's not paying attention. That's the macro side of me, really just risk aware. In the meantime, I don't care what Nvidia does, honestly. I just want it to be done.
I don't think it's that. I don't think it's particularly
what the reaction
important.
is tomorrow.
Yeah, we've seen a broadening out. I think we're sort of, we've rotated to I mean, the mag's not going away, but we've rotated to real things, touchy-feely things. And I think that's to my earlier point that I was kind of getting towards was, maybe people start to focus on a little bit more. Like, I don't mind digital exposure, something like Netflix that has, unassailable moats. But, some things I think, these moats may not be as solid as they used to be. So, just trying to be more aware of things like that. And I think maybe this sort of rotation, especially, we saw a little bump in Home Depot. We saw some housing stocks do well. Maybe there's just kind of this sort of inkling of an idea that maybe at some point we do get a little drop in rates and
No. So I'm against this idea because, and I'll tell you why. It's weird that I'm against this idea because I'm very much one who tracks inversely. When yields soften, it is time to buy RKT. And clients know this. They know that when the 30-year falls, RKT goes up, which is rocket mortgage. Yeah. So I saw it go up and I said, oh my God, they're expecting the 30-year to fall. And that was Wednesday the 13th. And swear to God, the next day yields fell. Rocket has continued higher, but this is not a good play right now for home builders, because what has Trump done? Nobody's paying attention to this. This is what I do on Friday nights. So Trump has said not only is Canada going to get an additional 25%, is Canada going to get a 25% tariff, but lumber, soft lumber specifically, already has a 14% levy or 15% levy. So whatever it is, collectively, effectively, it's a 40% hit on Canadian lumber. What is Home Depot's number one line item? Do you know? I know. 2x4s. So I cannot get excited about Home Depot. In fact, I took it off my recommended trend multi-year. I'm bullish Home Depot. And as soon as he came out with that, I said, nope, I'm taking it off. And I think it's a big honking trend reversal. I think home builders are in trouble. I think Home Depot's in trouble because of that. Now, if he was to recant, if something gets, settled, then I can go back, right? But for right now, Home Depot and home builders, no bueno in my book because of the headwinds hitting on the Trump tariff threat. I don't think it's a threat. I think he's absolutely going to do it. Ta-da! Building supplies. Yep. Okay, so snow earnings, that actually is part of the ecosystem. It's also part of SaaS reacceleration theme. CFEL, there are some plays in there that look pretty good. You did get a question, by the way, Hans, about any suggestion on managing Tesla. 375, 300 May expiry, bear risk ratio. I see strong support, 265, 275, and time on my side. Thoughts on that?
Are you're long the 375, short the 300? Is that it? I'm not sure. But yeah, I see that support too, 270. I do. I see support there around 275. I wouldn't panic at this point. I think we do get a move back towards 350. I'm assuming you're short that 300 and long the 375. So basically you're going to be into Tesla at $300. So yeah, you've got to be comfortable with that. Got a little bit of time to play with this. What you could do is you could roll that put down and try to get something similar. So if you can roll down to maybe like a 275, something like that. If you can do that for hopefully maybe a small credit or even just sort of kind of even money, then you'll give yourself a little bit of room there. You might have to roll out in expiry. But yeah, not much you can do at this point as it's starting to get in the money. If I've got that right. Oh, you bought the 375. Yeah, sold the 300. Right. Yeah. So you bought, yeah, you're up. Roll down is debt, but rolling out 1 month is nice credit. Yeah, that's it. Exactly. Rolling down may not be good within the same month. So you might have to roll out just to kind of do that. So, I mean, I would, if it's a name that I don't like, I maybe just kind of cut the position, wait for it to stabilize. But if it's something you really like, I don't mind the roll.
It's funny, totally aside, I know we're going over and folks want to listen to Nvidia, but today I noticed in Tesla some very large June 2026 contracts that hit 40,000, 60,000, whatever it was, and they were like 950 by 960. It was a call spread getting sold. So big hedge fund, not little, like 100 million. It was something already built up, and they've been basically adding on to it. So at kind of, what was it? 34 million, another one. Anyway, the point is, I wanted to ask you about this, but we don't have any time. So I will hit you up next time on this Tesla. I also see the 200-day for Tesla and then a snapback rally. Doesn't mean Tesla's gonna, go to all-time highs, but definitely as it relates to this whole process, to me is a top. These high beta, high flyers that literally went 490 to 290 in Tesla in very short order, I might add, is the volatility that we talk about for 2025. Big picture, markets are still sideways, but under the surface, there has been a breadth breakdown that continues. We are having this kind of 200-day start to kind of peter out, go sideways, and eventually it'll roll over, but it can take months. So in the meantime, this is reversion to the mean, and then they bounce, they make a lower high, reversion to the mean, then they bounce and make a lower high, and over time they start to roll over. So this is the not early cycle. This is late cycle behavior. I'm still looking at end of year being more bearish than bullish. But in the meantime, we definitely ran past, I think, everyone. Any final comments, Hans?
So is there something you need to see on your value growth chart that's going to make you feel like that isn't going to happen, or is it just horse out of the barn? and this rollover is happening.
The rollover is multi-phase. This isn't just from Wednesday until Wednesday. Like literally this started last Wednesday. The suggestion was, okay, keep it under 539 for the Qs because all those divergences were coming in and it looked like we were going to have this volatility. I still see volatility. What we had was sector rotation in lieu of volatility. So this is what I'm saying is right now, my sector rotation read is that it needs to base now. It needs to stabilize now, which means we could get this 200-day tag by Tesla and then have a powerful bounce, right? And that's what we need to kind of repair. So we need to repair. We need that growth ratio to stop falling and to go into sideways repair. Then it forms a pattern and can continue higher, or obviously it continues in its trend, which is lower. If it was to break, it's going to be because we have a macro trigger. The macro trigger could be maybe the debt ceiling, but TGA, as we talked about, the Treasury General Account is drawing down, which is ballast for the market. So typically when you have TGA drawing down, you have an opportunity for the market to not sell off too violently. 3% from all-time highs for SPX and 6% from NASDAQ 100 is not a correction. It's a pullback. Exactly. Yeah. And folks are going to and defend some of these high flyers. But the problem is what happens after the bounce. We'll talk about that next Wednesday.
Take care, everybody. Take care, Samantha. Thank you again.
Yeah, sorry, we didn't get through all of them.
No problem. We'll get to them.
Okay.
Okay, stay safe, everyone. Take care.
Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.